What if I told you some of the wealthiest business owners you've never heard of make more money than the founders of flashy startups? Most people chase the next app, restaurant, or AI idea while quietly ignoring businesses that rich investors buy over and over again. Today, we're going to uncover the overlooked businesses that consistently create wealth, why sophisticated buyers love them, and how you can recognize them before everyone else does. By the end of this video, you'll understand what separates a profitable asset from a demanding job, why recurring cash flow often beats rapid growth, and how to evaluate businesses the way experienced buyers do. Think of the business world as an iceberg. The exciting companies sit above the water where everyone looks. The real money often sits below the surface, hidden in plain sight. And that leads directly to the first characteristic every great acquisition shares: our required disclaimer. This video is for educational and informational purposes only and should not be considered financial, investment, tax, legal, or accounting advice. The first thing experienced buyers look for isn't excitement, it's predictability. Imagine two machines. One spits out random coins whenever it feels like it. The other quietly drops $10 every hour without fail. Which machine would you rather own? That's how investors evaluate businesses. A company producing dependable monthly cash flow is usually worth far more than one with unpredictable revenue. According to valuation firms and private equity research, recurring revenue businesses often command much higher sale prices because future income is easier to estimate. Whether it's commercial cleaning, pest control, or managed IT services, predictable income lowers risk while increasing value. Once you understand why consistency matters, you'll start seeing opportunities most people completely overlook. Here's something that surprises many first-time entrepreneurs. Boring businesses often produce extraordinary returns. Sewer inspection companies, parking lot striping contractors, commercial laundry services, and industrial waste removal rarely make headlines, yet many generate impressive profits year after year. Picture two storefronts. One has a long line because it's trendy. The other sits quietly serving businesses with contracts already signed months in advance. The second owner often sleeps much better at night. Businesses solving ongoing operational problems usually face less competition because fewer people dream about owning them. Ironically, that's exactly what makes them valuable. But recurring demand alone isn't enough. The next ingredient makes these companies even more attractive. Imagine trying to fill a bucket with water while someone keeps drilling holes in the bottom. That's what running a business feels like when customers never return. Rich buyers prefer businesses where clients stay for years instead of days. Think about monthly landscaping contracts, HVAC maintenance agreements, security monitoring, or commercial janitorial services. One customer might generate hundreds or thousands of dollars every year without constantly paying for new advertising. Consider a company with 500 clients paying $150 per month. That's $75,000 arriving every month before a single new customer is added. Suddenly, growth becomes much easier because today's sales help fund tomorrow's expansion. Now let's see this principle working in a real business. Picture a husband and wife team purchasing a small pest control company with annual revenue of $900,000. At first glance, nothing looked remarkable. Their secret wasn't inventing anything new. They simply focused on keeping customers longer, adding annual service plans, and improving technician scheduling. Within 4 years, recurring contracts doubled, while marketing costs barely changed because satisfied customers referred neighbors. Revenue climbed to nearly $1.8 million, but profits grew even faster. The business had become more valuable because predictable income increased buyer confidence. The owners weren't just earning more, they had created an asset someone else would gladly purchase. Their success reveals another pattern experienced investors almost always follow. One of the biggest opportunities hides in industries made up of thousands of small local businesses. Imagine a puzzle scattered across a table. Each piece alone has limited value, but assembled together, it becomes something much larger. That's exactly how consolidation works. Industries like plumbing, roofing, HVAC, auto repair, and home health care often consist of independent owners nearing retirement. Investors buy several companies, improve operations, reduce duplicate costs, and create a much larger organization worth significantly more than the individual businesses combined. They aren't inventing demand, they're organizing it. Once you recognize this pattern, you'll notice acquisition opportunities almost everywhere you look. Ask yourself one question. What businesses continue operating whether the economy is booming or slowing down? People delay buying luxury products, but they still need clean water, repaired roofs, functioning air conditioners, medical care, trash collection, and payroll processing. These are essential services. Visualize a sturdy bridge standing while flashy billboards around it collapse in a storm. Essential businesses often prove remarkably resilient because customers can't simply stop buying. According to labor and economic data, many maintenance and repair industries experience far less volatility than discretionary consumer sectors. Stability attracts investors because stable earnings support higher business values. But there's another hidden advantage many people completely miss. Many entrepreneurs proudly announce million-dollar sales while quietly earning very little. Experienced buyers care much more about profit than revenue. Imagine two businesses. One generates $5 million in sales but keeps only 5%. Another earns $1 million while keeping 30%. Which owner actually becomes wealthier? The second business produces $300,000 in operating profit compared with $250,000 for the larger company. Bigger isn't always better. Buyers analyze margins, cash flow, customer retention, and operational efficiency before looking at total revenue. This simple shift in thinking explains why modest companies sometimes sell for astonishing prices. The final lesson before we continue ties every one of these ideas together. Most people look at businesses the same way shoppers browse a store. Wealthy buyers look at them the way farmers evaluate productive land. They ask, will this produce cash next month, next year, 5 years from now? Can it operate without the owner working every hour? Can profits increase through better systems instead of longer days? That mindset changes everything. Instead of chasing whatever seems exciting, you begin searching for dependable engines that quietly create wealth year after year. And once you start thinking this way, you're ready to examine the specific categories of businesses that sophisticated buyers repeatedly acquire, and why almost everyone else walks right past them. Imagine buying a building where your customers do most of the work themselves. That's essentially the self-storage business. Tenants move their belongings in, secure their own units, and often stay for months or even years. Operating costs remain relatively low because there are few employees, little inventory, and limited daily customer interaction. Picture rows of identical boxes quietly generating monthly rent like tiny vending machines. A 300-unit facility, averaging $140 per month, can produce more than $40,000 in monthly revenue before considering ancillary income like truck rentals or insurance. Rich investors aren't buying buildings, they're buying dependable cash flow. But there's another overlooked business built on the same principle of recurring necessity. Most people see a car wash. Investors see a subscription business. Unlimited monthly wash memberships have transformed many locations into predictable cash flow machines. Instead of hoping customers return, owners encourage automatic monthly billing whether someone visits twice or 20 times. Imagine a conveyor belt where every clean car drops another coin into a growing pile. If 2,000 members each pay $30 per month, that's $60,000 in recurring revenue before serving a single walk-in customer. Add efficient equipment and controlled labor costs, and profitability improves dramatically. Suddenly, washing cars doesn't seem ordinary. It looks like a scalable financial engine. The next business is even less glamorous but often more profitable. Nobody dreams of owning a waste collection company, which is exactly why they remain overlooked. Trash doesn't care whether the economy is booming or slowing. Homes, restaurants, construction sites, and manufacturers all produce waste every single day. Picture a calendar with every square marked pickup day. That's recurring demand in its purest form. Routes become more efficient as additional customers cluster together, meaning every new stop can increase profitability without proportionally increasing costs. This network effect creates powerful local advantages. Rich buyers understand that consistent demand combined with route density can produce remarkably stable earnings, and stability makes financing future acquisitions much easier. Here's a mistake many entrepreneurs make: chasing huge contracts while ignoring thousands of reliable homeowners. Businesses like HVAC, plumbing, roofing, electrical work landscaping, and pool maintenance spread risk across hundreds or thousands of customers. Imagine a tree with hundreds of branches instead of one giant trunk. If one branch breaks, the tree survives. Losing one homeowner barely affects revenue, while losing a single large commercial client can devastate another business. Many successful home service companies also sell maintenance plans that create recurring income between emergency jobs. Diversification isn't just safer, it often makes the business significantly more valuable when it's time to sell. Now let's look at another industry quietly benefiting from long-term demographic trends. One of the strongest business trends isn't driven by technology, it's driven by demographics. As populations age, demand continues growing for home health care, assisted living support, medical transportation, mobility equipment, meal delivery, and companion care. According to U.S. Census Bureau projections, older adults represent an expanding share of the population for decades to come. Picture a rising staircase rather than a roller coaster. Businesses serving long-term demographic shifts often enjoy demand that steadily increases regardless of changing consumer trends. Investors aren't betting on a fad, they're aligning with population changes already happening. The next example shows how one entrepreneur built substantial wealth by recognizing exactly this kind of overlooked opportunity. A regional investor purchased 3 small commercial cleaning companies whose owners wanted to retire. Individually, each business generated around $1 million in annual revenue and operated independently with separate offices, scheduling systems, and accounting staff. Instead of changing the service, the buyer combined administrative functions, standardized pricing, negotiated better supply contracts, and cross-trained employees. Expenses fell while customer retention improved because service became more consistent. Within 5 years, combined profits had nearly doubled, even though total revenue increased far less dramatically. The real value came from operating smarter, not simply getting bigger. That illustrates one of the biggest wealth-building principles sophisticated buyers understand. Many people accidentally purchase a full-time job disguised as a business. Wealthy buyers search for systems instead. Imagine 2 bicycles. One moves only if you pedal constantly. The other has a small motor that keeps helping even after you stop pushing so hard. Businesses with documented procedures, trained managers, scheduling software, recurring customers, and measurable performance continue operating without the owner making every decision. That's what increases value. Buyers pay premiums for companies that aren't completely dependent on one person. Every improvement that reduces owner dependence doesn't just save time, it often increases the future selling price. The final lesson brings every idea together into a simple decision framework. Before buying any business, experienced investors mentally work through 4 simple questions. First, will customers still need this service 5 years from now? Second, does revenue repeat automatically or require constant selling? Third, can operations become more efficient through better systems or acquisitions? Fourth, if I step away for a week, does the business continue functioning? Imagine 4 filters stacked on top of each other. Every attractive acquisition passes through each one. The more boxes a business checks, the more valuable it becomes. Suddenly, flashy ideas become less impressive, while dependable businesses become far more exciting. That shift in thinking changes how you see opportunity forever. The biggest lesson isn't that self-storage, pest control, plumbing, waste removal, or home healthcare are magical businesses. It's that wealth often hides behind ordinary work-solving everyday problems. Rich buyers train themselves to recognize recurring revenue, essential demand, strong margins, scalable systems, and opportunities to improve operations. They stop asking, "Is this exciting?" and start asking, "Will this produce dependable cash flow for years?" Once you begin viewing businesses as income-producing assets instead of interesting ideas, you'll notice opportunities almost everywhere. And if this changed how you think about building wealth, the next logical step is learning how wealthy investors actually find, value, negotiate, and finance these overlooked businesses before anyone else even notices they're for sale. Thanks for watching. If you enjoyed this video, please like, subscribe, and turn on notifications so you don't miss the next one. See you in the next video.